Welcome, everyone. My guest today is Editor Chris Clow to talk about how reverse mortgage companies are doing in this environment and the particular risk they face from a government shutdown.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to housingwire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
Chris, welcome back to the podcast.
Thank you so much for having me back, Sarah. I appreciate it.
It's great to have you back. And today we're going to talk about reverse, right? Which is fun. You, of course, are the editor of Reverse Mortgage Daily, and you do all of our reverse coverage as well as doing a lot of the federal beat for forward mortgages. But there's been a lot going on. So I'd love to kind of dive in. And what I wanted to start with was the fact that, we had most of the leading reverse mortgage lenders had a profit in Q2. I don't think you and I have talked about that, even though that's been a week or so.
Yeah, so probably the top line lender that posted a profit that quarter was Longbridge, a division, of course, of Ellington Financial, but it was quite a bit lower than the recorded profit they had in Q1. Longbridge net income attributable to common stockholders was $2.9 million, and this is on the basis of Ellington. But that's compared with $38.9 million in Q1. So I think, if anything, that's just indicative of the fact that this is a challenging operating environment. Like, it doesn't matter how you cut it. The fact that they posted a profit at all, I think, is pretty encouraging, and it says a lot about the discipline that they have maintained through all of this. And Ellington is very bullish. They continue to be very bullish on Longbridge's prospects, particularly when it comes to the diversity that keeping reverse mortgages has on their portfolio. So Ellington seems very, very bullish on what the prospects are for Longbridge, and if they continue to have positive results, even if they're diminished, the fact that they're positive at all in this environment is, I think, pretty telling. And then at Ocwen, which is Ocwen Financial Services, the parent company of PHH, which itself is the parent company, or I guess the owner of Liberty Reverse Mortgage. They posted a profit in Q2, and they recovered from a loss that was in Q1. And a big driver of that improvement was in its reverse mortgage servicing business. They acquired a reverse servicer called Reverse Mortgage Solutions back in 2021. And servicing has been a pretty big component of the profitability that Liberty has enjoyed, and by extension, Ocwen has enjoyed in the reverse space. Guild Mortgage, we posted about their results in Q2, both on HousingWire and on Reverse Mortgage Daily. The reason that we're including Guild at all in the conversation on RMD is because they acquired Cherry Creek Mortgage. They closed on that acquisition in March, and Cherry Creek is a big reverse player. So there hasn't been a lot of time really for Cherry Creek's reverse activities to influence Guild's earnings, at least on a broad basis. But one of the things that Guild's president and COO David Nayland said in the Q2 earnings call was that the reverse mortgage division, as led by Cherry Creek, is now fully operational. So we'll be really interested to see how things go when it comes to Guild's renewed push in the reverse space. They had reverse capability before, but with the acquisition of Cherry Creek, like, that shoots them probably into top 10 territory. So they almost overnight became a pretty big player in the reverse space just because of that acquisition. Less lucky, however, was Finance of America. So, of course, at the end of last year, there was a lot of tumult in the reverse business because reverse mortgage funding filed for bankruptcy. And then we've had these consolidations, and the biggest of those consolidations is probably that Finance of America was acquiring American Advisors Group, AAG, the biggest reverse lender in the space. So Finance of America, again, almost overnight, became the biggest player in the reverse space, but they recorded a $221 million loss in Q2. But its leaders largely attributed that to the negative impact of mortgage rates and spreads. And FOA still has a lot of work ahead to consolidate AAG into its existing corporate infrastructure, and those associated costs kind of drag down their earnings for the quarter. But they seem optimistic about cleaning things up by the time we get to the end of the year. So it'll be really interesting to see how they stick the landing.
Yeah, I wanted to ask you. So, we know on the forward side it's been just brutal. Although there are people who are, making margins and doing okay. On the reverse side, what are some of the things as you look at the fact that home prices are still high, but also the kind of mortgages that they take out as far as the interest rate? How do you think the rest of the year is going to go?
So I've talked to a couple of analysts about this, and the emerging consensus seems to be that uh, the floor of volume may not have been reached yet. We still might see some volume drops by the end of the year, but all things considered, they're probably not going to be as bad as they could have been because home price appreciation continues to be pretty elevated. We just saw that, and I actually have a story to write about this, but senior held home equity ticked up in the most recent quarter. So it is now, I think, closer to $13 trillion total from a slight dip in I think it was Q1 of 2023. So the senior held home equity levels remain very high, and I mean they just exploded over the last couple of years. So that's got probably going to do it's going to do some of the work in keeping the reverse mortgage business on track, but a lot of the challenges still remain. There is still a very difficult liquidity challenge that is challenging the entire industry, most especially just a handful of home equity conversion mortgage-backed securities issuers for Ginnie Mae. And one of the things that I found pretty interesting is that there's a national reverse mortgage conference that's gearing up to take place in about a month in Nashville, and RMD will be there. I will be there. But Elena McCargo, the president of Ginnie Mae, has just been announced as a speaker. And I know that people across the industry are going to be very, very interested in what she has to say in terms of her commitment and Ginnie Mae's wider commitment to the HMBS program, but also, what kinds of policies might Ginnie Mae be able to introduce in concert with FHA and HUD to potentially create more liquidity in the reverse space. When RMF went out of business, their entire portfolio was seized by Ginnie Mae, like just about a month after RMF filed for bankruptcy. And that the size of that portfolio has been a serious challenge for the company. And it has necessitated additional operational staff, and they've asked for additional appropriations from Congress, and not to get too far ahead of things, but things aren't looking good on the compromise of financial disbursements from the federal government, if conversations in Congress right now are any indication. So I know that the industry is going to be really, really interested to hear what Elena McCargo has to say. And also speaking at that event is going to be Julia Gordon, the FHA commissioner, who spoke at last year's event, but she is always going to be a major point. The FHA commissioner generally is always going to be a major point of contact that the reverse mortgage industry has with the overseers of the HECM program at HUD and FHA.
No, thanks for keeping us updated on that. And yes, you and I will talk a little bit about the possibility of a shutdown in just a minute. I did want to say in the story where you're talking about, looking ahead and okay, this is what those companies did in Q2. One of the opportunities that was identified by Longbridge was distressed opportunities in reverse mortgage space. So tell me a little bit about that.
So Longbridge has been pretty active in acquiring portfolios from these companies that have been distressed, most especially reverse mortgage funding. It has provided an opportunity to potentially expand its presence when it comes to holding those loans and potentially, maybe repackaging them. I'm not exactly sure. They're not talking a lot about what their strategy will be when it comes to the acquisition of those distressed assets. But the fact that you have Ellington in particular looking to pick those up at a discount, I think says a lot about the general attitude that the company overall has about the strength of the reverse space going forward. Ellington and its CEO Lawrence Penn have talked a lot pre-acquisition of Longbridge and in the year since the acquisition that look, demographics are on. It's a common refrain that we go to, right? Is that demographics are on the side of this industry, and considering the height that home equity levels have reached for seniors over the past couple of years, that is a distinct opportunity for the expansion of a presence in a space that is designed to serve a population that the wider United States is just going to become uh, more in line with as time goes on. So I'm not sure exactly what other distressed assets they may be looking at. I'm not sure if RMF's full portfolio has been exhausted in the wake of its bankruptcy. They might still be looking at picking some stuff up from RMF. I'm hearing rumblings, nothing confirmed, but that there might be another company that might have to look to selling parts of its portfolio, and it's something that I'm diving into. But overall, right now, it's just the demographic game and how these companies are going to be able to serve senior populations going forward.
So great segue into the next thing that I wanted to ask you about, which was a report that you wrote up, and it was a survey that found that almost a quarter of seniors are planning on their full retirement is Social Security, which this is exactly why we're so bullish on the reverse space, the demographics, combined with the fact that many people do not have the retirement savings that are going to carry them through, and we see that the solution to that in many ways could be right, depending on how it goes out for people, is the reverse mortgage. So tell us a little bit about that report, which, by the way, is kind of terrifying.
Yeah, I agree with you. So it's actually wider than just seniors. This was a survey of 1,000 adults, generally speaking, and yeah, nearly a quarter of them are only looking at Social Security as a path to provide some semblance of money coming in after they retire. And the thing that is so concerning about that is that for years the Social Security Trust Fund has kind of been on the ropes, and there has not been an abundance of political will to try and shore it up. There have been discussions, I think, over the past few years about creating some kind of a plan to shore up the solvency of the Social Security Trust Fund, but entitlement programs are such a lightning rod, relatively speaking, on Capitol Hill that there are flagrant disagreements, mostly between the two major political parties, about how exactly to accomplish that. So it really does crystallize some of the most concerning components of this survey. 23% of respondents plan to rely exclusively on their Social Security benefit payments, while 28% expect those benefits to cover more than half of their spending in later life. And I mean, I think most Social Security beneficiaries now, even those that might have bolstered the amount they can take home by prolonging and waiting until age 70 before they begin tapping, uh, that's not really how it works. And the condition of Social Security is not getting better. If anything, it's getting worse and more precarious. And an absence of political will to do anything about it doesn't really improve the situation all that much at all. In fact, it makes it worse. So it is absolutely concerning. And I think it does help reverse mortgage professionals to have another component of the conversation with their prospective clients about, well, what is your plan? Does your plan just include Social Security, or do you have other assets that you're going to be able to call upon? Do you have substantial savings, or do you need to look into tapping your home equity to bolster your cash flow in retirement? So it is a bit of a wake up call for anybody that looks to the future and what their financial situation can be. And Granted, maybe there are some people who plan on working literally for the rest of their lives, but the best laid plans of mice and men, right? There might be something that comes along that prevents you from being able to work when you're in your mid 70s. So it's good to have some kind of a backup plan should things go awry.
It's interesting. So if the survey is of all adults, then you think, okay, well, if you're in your 20s, you might not have any idea what you're doing, with retirement savings. I would think you'd have some understanding that like Social Security should not be your main safety net. But I do think it was interesting because we know that, as you said, demographics. So I think, is it 2030 when all of the baby boomers will have reached 65 by that age? Is that the magic number that we're looking for?
Yeah, I believe it. And then 2024 is actually supposed to be the beginning of peak 65, where a certain threshold of members of that generation will have hit that age, and it's just going to continue accelerating until the end of that generation. So yeah, there are certainly some issues that need to be addressed when it comes to shoring up the finances of later life. And I understand on some level it's not a comfortable conversation to have, especially if you are a younger person. It's not really something that you want to think about, but that doesn't diminish that it is prudent to think about such things. And the reverse mortgage industry has long made a case of you know potentially using that product in some form or fashion in concert with Social Security. Some people have gone the route of saying, take a reverse mortgage out. It will allow you to prolong taking your Social Security benefits until age 70. Or on the, maybe the more needs-based spectrum, then this is something that can bolster your Social Security payments, as long as you can meet the other loan obligations, like keeping your house in order, maintaining your homeowner's insurance, and continuing to pay your property taxes. So it interacts with so many different components of this discussion, and having it sooner rather than later, yeah, it's not going to be the most comfortable topic to think about or discuss, but it might be a beneficial thing in the long run.
Well, and I think we would just raise our hands here and say we do not expect some silver tsunami to come. So, because where are people going to go if they're currently living in their house and they don't have a ton of savings? I'm not sure that they could sell their house, but then that's something that's could potentially run out. So what we see is that people are looking to reverse mortgages. They are giving handing down their homes to other people. That's sort of the whole meme right now, right? Is like boomers like, oh, I have everything. I've paid off my house. It's whatever, and I'm never going to leave it. So, just wanted to kind of note that as well, is that we don't think like, oh, 2024 or 2030 is some magic year when we're going to see a ton of inventory come on the market. We might see more reverse mortgages though.
Maybe. I mean, it's certainly something that the industry is hoping for, and I think a lot of the companies are positioning themselves to serve as something of an answer to those emerging problems. And that's going to be one of the things I'll be really interested to see when I'm on site in Nashville among so many other reverse mortgage professionals, is how much more potent, if more potent, these conversations have become with prospective clients on the originator side, as well as just the business strategy at the executive level. What kinds of discussions are they having when it comes to fully digesting a lot of these evolving realities? That's definitely going to be something I'm going to be paying very close attention to.
And that is a great place to find out, is at the trade association meetings every year. So in the last few minutes we have, Chris, I would love for you to give us an overview. You have done some reporting on what a government shutdown would mean specifically for the reverse space, which I thought was really interesting because it's not something I had thought about before. Of course, we really hope that we do not have a government shutdown, but we know that these things can happen. And so maybe give us a few pointers there about what would happen.
Sure. So this, I would be very surprised if this is something that is talked about abundantly on the forward side, just because the forward mortgage side, of course, is much more insulated from the government, not completely by necessity, but it is much more insulated than the reverse side is, because the reverse mortgage business is very much like a public-private partnership. The vast majority of reverse mortgage products that are originated are home equity conversion mortgages, and that is a program under the purview of the Federal Housing Administration, which itself is under the Department of Housing and Urban Development. So naturally, if there is a lapse in appropriations that comes from a government shutdown, it has a pretty big impact on reverse mortgage business. And probably the most potent impact is that you can't endorse HECMs for FHA insurance. And if you can't endorse HECMs for FHA insurance, then you can't take the loan further. That is by far the biggest impact that a government shutdown would have on the reverse mortgage business. This is actually something that the business most recently had to deal with between the end, it was December 22nd of 2018 through January 25th of 2019. Congress was at an impasse related to funding over border security, and it led to the longest partial federal government shutdown in U.S. history that was not resolved until the end of January. So HECM endorsements during that entire time couldn't take place. The longer term impact was that the performance metrics for the reverse mortgage business were just totally obfuscated for months afterwards. It was very difficult to tell where the industry stood because there was so much noise that was created from the shutdown. So as soon as the shutdown ended, there was all of a sudden a big log of HECMs that needed endorsement. And it was very difficult to tell what the health of the industry was up through, I think, the middle of 2019. And that's more of a headache than anything else. But having that metric information not available, it's a concerning component for people who work in the reverse mortgage business and want to have some idea of where things will go. HECM endorsements were immediately halted when the government shut down because there was a lapse in appropriations for FHA. But there is a contingency plan in place. In fact, I looked up the most recent contingency plan that HUD has put together if a lapse in appropriations takes place for a shutdown. One of the nice things that should be at least a little reassuring to people in the business who are most sensitive to their borrowers and their borrowers' financial condition is that HECM payments do continue. So the disbursements that go to borrowers will continue because HECM payments fall under the standard of the minimum operations necessary to support FHA's existing portfolio. So at least on that front, borrowers who are already in their reverse mortgages are fine. But it does create a problem if a needs-based borrower might come to an originator during a government shutdown. They're going to be kind of out of luck until people in Congress get their act together and sign a spending plan into law that then goes to the president's desk. And it seems like I wrote that story. It was on the 14th, so about 5 days ago from the time we're recording this. And talk of a government shutdown has only amplified in terms of the end of this month. So there's apparently Congress is deliberating a potential continuing resolution that would kind of kick the can down the road for 30 days. But there's so much rancor, particularly in the House, in the Republican conference in the House, that is even seeming like a far-fetched possibility at this point. So it would probably be a good idea for reverse mortgage professionals to potentially prepare for a government shutdown, unless, but that could change. There could be a miracle development and either a CR is signed or, in a big miracle, like an actual budget is signed that takes us into next year. But we'll see what happens. It's hard for me to believe in miracles when it comes to political rancor these days.
Me too, Chris. I love your optimism on that. Let's hope for that. Fingers crossed. It is interesting that it won't necessarily affect the borrowers, but it definitely affects the industry professionals who are shut out, can't get updates. Much more on the reverse space than in the forward space. So thanks for walking us through that, and just thanks for being on as always.
Of course. No, thank you very much for having me, Sarah. It's always a pleasure.